All right, you guys, we are recording, and again, we have Stephen here. Stephen is our favorite credit guy. And Stephen, go ahead, man. Tell us
Thank you.
about this new FICO thing.
Thank you. Thank you so much. For those of you who don't know me, my name is Stephen Robert. I'm the CEO of Bedrock Credit America. For the past 15 years, I've been doing credit education and restoration. And throughout that entire time that I've been doing this, we have always been using something known as the FICO Classic scoring model that was developed in the year 2000. Well, as of 2 weeks ago, Fannie and Freddie, who buy all the back-end loans basically, have finally said, hey guys, we're going to make a change. After 22 years, we will in fact adopt a new scoring model at some point in the future, and we're not sure when that's going to be. Could be 12 months, could be 24 months. We really don't know yet. But sometime in the future, we're going to stop using FICO Classic and we're going to start using FICO version 10T and Vantage 4.0. So that in itself is significant because now we're not just stuck with FICO, we're also bringing Vantage into the mix. And the good way to think about it is kind of like Microsoft and Apple. It's the two biggest competitors, and that's what Vantage is. And they've been banging on the door for years, and they finally got their foot in there.
Yeah, I got to tell you, I've never heard of Vantage. And so how is it different?
Well, first of all, what is it? It's actually the scoring model that the three credit bureaus came together and created because they saw FICO is basically just a scoring model that purchases the data from Equifax, Experian, and TransUnion. And it just came out in the 90s. And because of that, everybody started using them and they just had market share. So the three credit bureaus said, well, why are we losing all of this market? We're letting them buy the data. We already have it. Let's just take the data, make our own algorithm called Vantage. And they started with Vantage 1.0, then 2.0, then 3.0, and now Vantage 4.0 just came out. And that's what is going to be very comparable to FICO 10T. Now, to answer your question, Lisa, the parameters of what goes into a scoring model basically are the same thing in each one. And it was interesting because when they had Vantage 1.0 and Vantage 2.0, they had to use scoring models from like 100 to 1,000 points because FICO had I don't know the right word, but like a trademark almost on the 300 to 850. And when that trademark expired, they hopped on it, and Vantage 3.0 was 300 to 850. And now, obviously, Vantage 4.0 is also 300 to 850, same, and now FICO 10T is 300 to 850. But the parameters of what make it up are basically the same. However, how they're going to start treating things once these things get implemented, that's the big thing, right? So the first and foremost, the most important thing that you're going to have all these clients come to you and tell you is, oh, I read this article, I saw this, I don't have to do this anymore, I got to do this. None of this is applicable yet. Okay, so yes, correct. Credit Karma is by Vantage, or Vantage is Credit Karma Vantage 3.0 is what Credit Karma uses at Equifax and TransUnion, not Experian, because they don't do Experian. Okay, but so now you have Vantage 4.0, you have FICO 10T, but what the differences are going to be very substantially different than what FICO Classic uses. As example, you're going to get a client that says, I just read something that the new scoring models say, as long as the collection is paid, it's going to go to, and the balance is showing zero. Doesn't matter if it's on my credit report anymore. It doesn't impact me. So I'm just going to pay all my collections. Well, that's true. When we use FICO 10T and Vantage 4.0, paid collections won't impact the actual scores, but we're not using that yet. So if you get a client that just starts calling, paying all their collections, they're going to be shooting themselves in the foot because they're updating the data last activity. They're keeping the negative data on their credit report. And for the next 12 to 24 months, that's still going to be negatively impacting them.
So wait, can you stop there? So if they pay it off now,
yep,
and it says right on their credit report, they paid it off today, November 9th. Okay. Then when they do switch, they're still going to be impacted by that date that was on there, or will that date disappear?
The date will become irrelevant once we go to 10T. It's just until we go to 10T, that date's very relevant. Right. So that's where somebody could say, well, I guess it's okay if I pay everything. Well, yeah, in theory, once we use the new version, but right now we're not using the new version. So that's where we have to make sure we pay things properly to actually have them removed. The biggest thing that you guys are going to see and what's relevant starting today is FICO 10T. And what does the T stand for? Is it settled for less amount is considered paid or no impact? Okay, so let me answer that question real quick before I go into the 10T.
So the question is, if someone settles for a lesser amount, is that considered paid and will have no impact?
No, if you have a collection, whether you paid in full or you settle in full, a paid collection is now still going to impact your credit.
Right.
Based on the FICO Classic system, which is what we're currently dealing with. Once you hit FICO 10T and Vantage 4.0, it won't. But
What
again,
about settled for less?
Doesn't matter. If you have a collection and the balance goes to zero,
Right.
it's going to be zero. It's not going to impact the scores.
Okay.
So
But-
currently, the way I think we understand it is that recent activity on a collection account, paid, settled for less than full, is worse, harms the score more than just leaving an old one out there. But once we go to the new system, it's not going to matter. It's just going to report as a collection. If there's recent activity, it's not going to affect it. Am I understanding that right?
Yeah, you're absolutely correct. If you have an account in today's market or in today's credit FICO Classic system, if you have a collection and you pay it, that could actually update the data last activity and drop the scores and therefore hurt you. And then the fact that it's still on your credit report is going to hurt you. But once we get to the new system and it gets paid, when it's open, it hurts you, but when it's paid, it no longer hurts you, no matter what the date of activity is.
Okay.
Huge
Okay.
benefit.
Yes, potentially it's going to be a huge benefit in that regard.
In 12 to 24 months.
In 12 to 24 months, but that's collections. They haven't said anything yet about charge-offs. Now, I know you guys and your underwriters and all that don't care about charge-offs, but from a credit world, I do, because right now, FICO Classic shows collections and charge-offs are basically the same thing. And if a charge-off gets updated and updates that data last activity, it's going to drop your scores. They haven't said anything yet about if charge-offs in the new system are going to also not count as well. So that's something that we have to yet to be determined. So now let's talk more about why the trending data, the FICO 10T, the T stands for trending data. This is huge because people that think that they're gaming the system, especially when they like to use their points, are really going to be shooting themselves in the foot. So I constantly have clients that tell me, I like to have my credit cards for $1,000. I max it out every month because I get my points and then I can fly to Tahiti for free. Yeah, that's great. But once FICO 10T gets calculated, what it's going to do is look at the past 24 months of payment history. And if you're maxing out your cards month after month after month after month, the FICO 10T is going to drop your score significantly because you're always carrying a high balance. In the FICO Classic system, you could have that high balance, pay it down to zero, wait 30 days, have a zero, and boom, your score shoots up 100 points.
Right.
With FICO 10T, because it's looking at that trending data over the past 2 years, that goes out the window.
Isn't that only true if you're if you say your limit's 5,000, you spend 5,000, but if your limit's 50,000, you spend 5,000.
Well, yeah, then you're only at 10% utilization.
So,
So the
Rosella,
utilization still factors in, even though the trending data is there.
Yes, absolutely. Yep.
so
is
Rosella's
this-
got a great question, which is the same one. How are they going to calculate Amex?
Well, in FICO Classic, there's two types of Amexes, right? There's open and then there's a revolving Amex. The open Amex in FICO Classic is viewed as whatever you owe, you're at 100% utilization. So it's really shooting yourself in the foot to have a FICO in the FICO Classic to have an open Amex. So even if you put $100 on there, you're at 100% utilization. Or if you put $5,000 on there, you're at 100% utilization. You're always at 100% utilization or zero utilization if you have zero. In the new scoring model, great question, yet to be determined. We don't know if they're going to calculate that differently. The revolving one is going to get calculated the same way, but the open one, we don't know if they're going to treat that as, okay, is that still 100% utilization? Or are they going to look at it more like an installment loan where you're taking whatever you're taking, you have to pay that month. So therefore it's kind of like a utility bill where you have to pay it in full, which
Yeah.
again is going to be another part of what the new systems are going to do. Because now you're going to be able to start using things like utilities and rent as actually increasing your scores. Because in terms of your FICO scores and your Vantage scores, because there's tons of websites out there that say, here, add your trade lines and it'll increase your credit scores. And that's true. So if you want to go apply for a credit card or something and they're pulling the data, it can be in there. But the mortgage scores, because FICO Classic never considered those, you could never take that into consideration in terms of if you have utilities on there, if you have rent on there, things like that weren't relative before, and now they will be. They'll be relevant.
Well, it's funny that you say that because many of us have seen on our DU findings this already. This loan may be improved with rental history verification, and that kind of stuff is, look, it's hard to do. You know, it's hard to do, and so that'll be interesting. But we've all seen that already.
Well, but you have it from an underwriting standpoint, right? Like you could take the history and give it to the underwriter, and
Right.
it'll help from that point, but not the
Right.
scores.
Right.
So once the new system goes over, it'll actually now be helping the scores.
Yeah, but
in
how do
theory.
if that information is, okay, so a large percentage of rental history is not reported to the credit bureaus.
So it's going to have to get reported. And it looks like the way that's going to get done is kind of like what Experian does with Experian Boost, where you could basically go in there, sign up and say, I want to show that I'm paying these things on time. And you have to go through that process of here's my Verizon bill or here's my rent bill. So there's going to have to be, and again, that's kind of going to be part of the delay there of, well, how are they actually going to streamline putting that information in? Well, it sounds great that, okay, great. You can add your utility bill or you could add your rental. How are you actually going to do that? And that's something that they have to yet to explain to us how they're going to train. To me, it seems like Experian, Equifax, and TransUnion are all going to have their own little, hey, log on here, upload your documentation, and we can start adding this trade line. And I think that's ultimately what's probably going to happen.
Okay, but and again, devil's advocate on that, are they going to share that information? Because if they go on to Experian, then only Experian is reporting it, only Experian score is affected. Like, that's what I'm saying. So you'd have to go on to, in order to get this to positively affect all three scores, you'd have to go on to all three bureaus, right?
Mm-hmm. Yeah, you'd go on to and create three different submissions based off of what you want to upload. Now, with that being said, and we keep talking about the three credit bureaus because that's what we've known and loved over the past years and years and years. Yes, exactly. It's one of those hate-love relationships.
Yeah.
But in all the research I've been doing, they keep saying, hey, we're only going to use 2 credit bureaus going forward. So what does that mean? Meaning, are they going to drop one, or are they going to, the three of them going to duke it out, or are they going to have certain companies use certain ones? That's going to be a whole nother mishmash where we don't know how that's going to transpire.
Well, in effect, they do that now for us anyway, because we drop the high and the low and we use the middle.
Right. But now what are you going to do if there's only 2?
Right.
What do you say? Okay, well, now Loan Depot pulls it from only Equifax and Experian. Now what number do you use?
Right.
Do you average them? Do you just take the high? What is it going to do?
That's really interesting. Dave McDonald's having flashbacks to the 90s. Dave Rodriguez said, this can help us with first-time home buyers or clients that move here from another country to immediately stimulate getting a credit history and generate a score.
Yep.
Does that sound about right?
Yeah, it's definitely going to help them get a score or build a score quicker, because maybe they're not knowing that they need to open up the credit cards, but they do rent or they get a cell phone or something like that. I still think FICO, and I don't know about Vantage, I think they do it a little bit quicker, but well, I know they do it quicker right now in the new system, in their current systems. I don't know what Vantage 4.0 is going to look like, but right now in FICO Classic, you can't generate a score unless there's 6 months of activity. And that
Right.
generally has to come from a secured credit card or somebody gets added as an authorized user. Now, I think they're going to be able to also add the utilities or the rent, and that can start their 6 months of building that credit without having to open up a credit card or get added as an authorized user, which, by the way, the whole authorized user thing, which helps us so much. Hey, Steve, I got somebody at a 605. I need him at a 620 in 30 days. Well, let's add him as an authorized user. Boom, their scores go up. Guess what? Out the window. So the authorized user side of things isn't going to be helping anymore. It helps on a very small level, they said. Basically, it took from an 80-point jump you could get to like an 8-point jump.
Yeah,
So
but
it
we've
just-
been seeing findings on that state if the authorized user is affecting the score, it may be invalid, and the underwriter now has to determine, did the authorized user factor in? And if so, we have a bigger problem of like.
Yeah,
you
we
can't
have,
get the score.
we've had an underwriting problem on that for a few months, and like Maura said, they look to determine whether the authorized user stuff stimulated the score, and they want to know if they're an authorized user for a family member. So like they're, if Maura said, hey, Lise, I'm gonna add you to my credit card, we're gonna boost your score. Well, she and I aren't related, and that's a no-no. So,
Yeah, that's definitely something underwriters should be and could be looking at, especially with, there's a lot of companies out there that offer trade lines that you can buy. And I think they're trying to cut down on that, because basically an authorized user is a way to boost the scores by leaning on somebody else. And they want to be able to help people, but they also don't want people taking advantage of
all
the
right,
system.
hey, Eric's got a question. Go
ahead.
for it, Eric.
Yeah, I was just typing them in the chat. So actually 3 quick questions. So it sounds like self-reporting history, which we were just discussing, currently doesn't affect the score, but does show the history. But after 6 months of self-reported history under the new system, it can actually help their score. Is that correct?
Yeah, and it will impact the scores immediately in the self-reflecting history in the new system. I was
You
just
don't have to
referencing
wait
if
6
nobody
months.
if somebody doesn't have any scores, and now that's the only thing they put on there, they're probably going to have to wait that 6 months in order to generate a score. But if they already have other things and now they're adding that, that's going to help them, because now they're adding new good positive trade line history. And the other thing with that is you're usually not adding something that you just opened Verizon last month and now you're adding it. You probably had Verizon for the past 2 or 3 years anyway, and
Right.
now you're adding all this positive history into there. It's just going to be a matter of how does that data get to the credit bureaus.
Understood. Okay, another quick question. Revolving credit utilization ratios. In the past, from what I remember, I think 20% was the line in the sand, where if you have more than 20% on your card at the time that it's reported to the bureaus, that's when the revolving utilization ratio starts to really affect the score. Is that changing?
That was never true.
Okay.
think- What was the number? There was a number somewhere.
So the true metrics of how it was broken down in terms of debt utilization is based off of buckets. Okay. So, and just to understand, and I'll give you my little example here. So the best is 0. 0% is going to give you not only 0% utilization, but 0% risk perspective. So that's going to help you the best. From there, 1 to 15% of the credit limit would be bucket number 1. 15 to 30%, and that's where the whole under 30% comes in. 30 to 40%, 40 to 50%, 50 to 100%. Okay, those are the different buckets. Now, if you're at 87% utilization and you pay it down to 55% utilization, will your score go up? Absolutely. Any percentage you pay down your utilization is going to make your score go up. But as you jump buckets, that moves you on different scorecards, and therefore it's going to impact your scores greater.
Got it. Got it. Eric, did you have one more question? And then I know Terry's got one and Ira does.
I did, but it escaped momentarily. So if it comes
Okay.
back, I'll just raise my hand again.
All right, Ira, the medical collections, the impact of medical collections on scores and being reported. What specifically did you want to know about that?
But wasn't there something, Stephen, where if the medical collections were 500 or less, it was going to drop off or not affect scores? You told us something a few months ago, and we were expecting it to happen in July. What's the update on that?
So to clarify, as of July 1st, the new regulation or law, whatever you want to call it, is any paid medical collections will be deleted within 30 days. Okay. The whole concept of if there's a medical collection under $500 not being reported, that's probably not going to happen till the spring of 2023.
Okay,
So that is it. So if there's a $200 collection or $2,000 collection, right now it's impacting you. But once it's paid within 30 days, it's going to get removed.
nice. Terry, what's your question about the look back?
Well, Stephen mentioned that when you add a utility, you get all of that history in terms of, payment history. Is there a look back? Do they cut it off at, say, if you've got 5 years use with Verizon, do they use all 5 years? Do they look back just 2, 1? What's the?
We don't know yet. We don't know. It's going to be very much dependent on how they upload the information and how they're taking that data and therefore put it into the system. So they might only look back for like a year or two, or they might say, hey, you have 10 years of paying Verizon on time, you can upload all of it. So we're not sure what that answer is yet. And also keep in mind that isn't like, you could try to upload things through like Experian Boost right now, but in terms of the mortgage side of things, that's not relevant. So if you get a client that comes to you and says, hey, I know I have a 600 score, but I'm going to add all my utilities and that'll boost my to 700. No, it won't, because the FICO Classic system is still being used. And right now, FICO Classic does not take into account any type of past utility payments and things like that. So this is only once the new system goes live, which is anywhere from 12 to 24 months out from now.
Eric, you got one, if you remembered your question.
Yeah, and it just escaped me again. I apologize.
You got to write in the
Just
chat.
ask,
have a
don't raise
question.
your hand. Go
Wait, I have a question too.
ahead,
So,
Maura.
you know,
This is so
think
good. I'm sorry.
we see a lot of clients who maybe they get a 0% offer or 2% offer. So they take all their balances and they roll it to one card, which then affects the utilization, right? So now we have a bunch of cards and I think the clients think it's aggregate across and go, when you add them all together, I'm only at X%, but it is card by card. Is that correct? And can you speak to how the best way to handle that? If you know what I mean? Like, is it taking that
gotcha.
back and spreading it out to keep all the cards under, or having some at 0 and some a little bit higher? Like, walk us through that.
Sure. So first and foremost is utilization is looked at by card and collectively. So it looks at both sides in terms of how it's calculating the scores. Okay. Now what you're saying is, think of it, and I'll use a very simple example. Nothing's ever this simple, but I'll just try to use a simple example. Say there's one card on the credit report. It's for $1,000 and it's maxed out. And now they get another card offer and it says, here, you can transfer your balance. So they open up another card for $1,000 and they transfer it over from 27% interest to 0% interest. Okay. From a financial standpoint, that makes a lot of sense, because now they're paying 0% versus 27%. But when they open that card, it's going to take a hit for the inquiry and it's going to lower the average age of the credit file. So from that regard, it's going to go down. However, what just happened in terms of your utilization? And remember, 30% of our score is utilization. Right here, we're at 100% utilization with the one card. Once we open up that second card and we transfer the debt over, it's the same debt, but it's transferred over here, we're keeping this card open. So now what's our utilization percentage? 50%. And because it has such a lower percentage, that's going to help you boost your scores, because you just went from 100% utilization to 50% utilization simply by keeping this card over open, transferring the debt, helping yourself financially. And in this very simplistic example, the utilization aspect outweighs the fact that you took a hit for the inquiry or lowered the average age of your credit file. And then collectively, what you want to do is, and it goes back to my 5 credit card example, which I've done in the past, but I could do it again. But think of it this way. If you have 5 credit cards, each with a $2,000 limit, what is our overall combined limit? Well, it's very simply $10,000. And if I tell you, well, I want you to go out there and spend $2,000, What makes more sense, and more importantly, why? Is it better to put $400 on each of the 5 credit cards, leaving a nice small manageable balance? Or is it better to max out 1 credit card, leaving 4 cards at a 0 balance? Well, which one is better? Most people think, well, I'll put $400 each on each one of my credit cards, right? That seems more manageable. Unfortunately, that's not correct. What's correct is maxing out the 1 card. Why? Because the utilization overall is 20%, but in this situation with 5 cards with balances of $400 each, you're more risk that you versus 1 card that's open, you're more of a risk that the check gets lost in the mail, you forget to make a payment, auto pay didn't go through. So from a risk perspective, this is more risky than this, because with the 4 cards you don't owe anything, you can't pay late. So again, very simplistic example, but in the grand scheme of things, you have to keep your card open and active. But once you keep them open and active, you want to make sure you don't close down those cards, and you just want to make sure that your utilization is as low as possible. And it looks like Eric remembered his question again.
Go for it, Eric.
Yeah, so at what point do non-active cards with a 0 balance stop being considered in the scoring factor? You know, a credit card with a 0 balance that you've had for, after 6 months, it no longer factors into the score. Is that changing?
So it's when the card gets closed. So that each individual card is going to have their own thing, right? So you could have a Capital One card that says, well, you haven't used me in 6 months, therefore I'm getting closed. You could have a Macy's card that says, well, it's been a year and a half, and we want to stay open because we think that one day you'll have a bad day at work and you'll go on a shopping spree and you'll use the card again, right? So each card is going to have their own understanding of when they're going to close that card. But when the card itself actually gets closed, that's when it impacts your debt utilization. Because if a card is open and active, even if the balance is 0, that extra utilization is helping your situation. So going back to the example before, if you have this card that is a 0 balance because you transferred the debt to this one, and now it's at 0% interest, this is 27% interest, and you say, you know what, I'm not going to use this card anymore, I'm going to close it. Well, what we were just talking about, how it can really help you going from 50% utilization to 100%, or 100% utilization to 50%. Now we close this card, we're back up at 100% utilization again. So that's where closing cards can really negatively impact your overall debt utilization. However,
Okay.
Does that answer that question?
It does, yeah. So the advice of telling customers to, keep their old cards open, but use them twice a year, like spring forward and fall back. Go out, buy gas, pay the card off. That doesn't so much affect the score from the usage. It keeps the cards from being closed by the issuer, and
Correct.
that way it indirectly affects the score by keeping the utilization this year.
Eric, that's a
Okay,
great
another-
social media post.
Yep.
Right there.
Another
That's
quick one for non-bank consumer cards. Like if everybody remembers, the old Filene's card wasn't a bank card; it was a merchant card. Do those still hit you for 15 points until the card is no longer reported on the report?
Does it hit you for 15 points until the card isn't on the report?
Yeah, so not like the Community Bank or Synchrony Bank back cards, like the limited and all those that we see, which is a whole host of cards, or
Right.
Lowe's or Home Depot, but the actual consumer finance card, like Filene's
Yeah.
card was a private finance company. It wasn't an actual bank. And for private finance cards, this is my information going back to when I took credit scoring courses many, many, many years ago. But that
Okay.
used to be a 15-point hit for a non-bank consumer charge card to the credit report.
No.
no.
That's never been like that. And John, and again, this is all the information that I got is based off of John Olsheimer building the FICO Classic scoring model. And the way that he described it to me is all cards are created equal, besides American Express open cards, which are their own little animal. But in terms of if it's a bank card, if it's a consumer card, if it's bank finance or their finance, they all are created equal in terms of the utilization and the longevity that it can build and all that good stuff. So you're taking a hit for 15 points by having that card report or not report or whatever.
So Terry's
Okay, super
question,
helpful. Thank you.
Yep.
Terry's got a great question. Does that risk translate to DU? And you know what, Terry, right now that's an unknown. Until they start to test and implement this, and as Steven said, it could be 12 to 24 months. You know, it's going to be a whole nother level for DU. It's going to be a whole nother level. So, you know, buckle up, Buttercup. This is going to be a rough ride when they start to to change that. But we've seen this before, you know, when DU changes risk tolerances. But I kind of like knowing it's coming. I don't know about you guys, but I kind of like knowing that it may be coming down the pike. Steven, anything else? What else, you know, what can we communicate to our customers like that? To number one is, you know, okay, hey, Boost Experian is great, but you know, it's only going to affect that one score, et cetera, et cetera. And number two, like, don't make any changes right now, you know?
Well, no, they definitely need to make the changes, especially with the trending data, because that one I hear every day. Oh, I like to
Okay.
max out my credit card and get my points. Well, if you're planning on buying a home in the next 12 to 24 months, and that's the game you're playing, you're going to be sorely surprised within 24 months when they go to FICO 10T, and then all of a sudden the scores drop 100 points because you like to max out your credit card and get your points. And then all of a sudden those points don't seem so valuable anymore because your interest rate is so much higher because they're looking at, well, you're maxing out your cards every month.
Okay, I like that. You
like
guys, that's an easy takeaway and a great header for a social post. Like, yeah, don't max out your credit card for points. You
So
know?
I think the two takeaways here are, number one, when consumers are reading stuff, let them know this stuff isn't going to take into account yet. So utilities aren't going to take into account yet. Paying collections aren't going to take into account yet. So be aware of that. Things that are going to take into account that you need to act now is the trending data stuff, because that
Okay.
will impact the underwriter's decisions and or the scores in the next 12 or 24 months when they flip the switch. And because it is 24 months that the trending data looks back at, you need to make your change now in order to actually benefit that when the system goes live in 2 years from now, which is a
Okay.
mind-blowing concept, but that's the way it has to be. So I think we hit a couple key points, like you said, Lisa, where you can say, hey, bullet point, like here's a big marketing thing. You need to start, you have to change how you're paying your credit cards today in order to help you get your mortgage in the future.
Yeah, okay. What else? What are not, let's do a couple of bullet points on that. Maxing out your credit cards monthly, change how you pay your cards, you know, to help you qualify for a house.
Mm-hmm.
What else can we use for, you know, like to give these pieces of information?
I think the medical one is huge because medical people still are under the impression, because they've read articles, medical collections don't impact me anymore, so it doesn't matter. But the point is medical collections do matter, but if you pay them or insurance pays them, within 30 days, they're deleted.
Okay. 30 days of being paid, they're deleted.
Correct.
All right.
What was this question? Makes sense, which is why we ask our clients when paying down debt to start with the smallest card balances first. All cards are, okay, yeah, that was just a comment. Do we have one-page fact sheet you can send out? Yeah, Brad, well, first of all, I have my like little one-pager that I sent to Lisa, but I'll send you that, and then I'll see what other tips I can give you that are more focused on the newer system that are going to be coming out. So it's more of
That'd be
a
great.
preparation, like, hey guys, pay attention to what's about to happen and make these changes now.
Right.
I also included my phone number and my email address in there. So feel free to reach out if you guys have any questions and all that. I offer free consultations, as Lisa knows. And even if it's just a question about a situation about, hey, my client read this and they want to know about that, I'd be happy to answer those things and get you that information. But yes, Brad, I will see what I can
You
do
guys,
to put together
and
something.
just for those of you who are newer to the call, Steve and I have worked together probably for more than 10 years.
Yeah.
Okay. It's been a really long time. And he is my number one go-to guy because I love the way that he treats our mutual customers, and he has a proprietary system so that, like, there are times when he'll call me like, hey, Lise, we just finished up the credit. I'm like, that was like 2 years ago. And I'm getting a lead back that he's been working on for 2 years that I probably categorized as not in this lifetime. You know what I mean? But they did what Steven said, and their credit scores have increased. So, you know, yeah, Ira had the similar experience, I guess. Ira, you there? I don't know if he's there.
Sorry,
but,
I'm muted. No, and Stephen is great, and I appreciate your follow-up, Stephen, that he doesn't just
Thank you.
email them or call them once. You know, have we said here on this call many times, in sales,
Follow-up
many of
is
us
everything.
suck on follow-up. So Steve doesn't suck. He's one of us. He's good. Thank you.
He's
Wait,
good.
thank you, Ira.
Yeah,
Okay,
appreciate
so
that.
Nate says, what do we have? Well, Steven's sending me some stuff. I've tagged a lot of stuff off his website. Nice website, by the way.
Thank you.
He's
I
got a
redid my
great
website.
video on increasing your credit score. You did that interview. So
Yep.
I thought that was really good. And guys, I think this is some great stuff for us to be able to communicate with our clients and our business partners. Our business partners. All right, we are a little over. Does anybody have a last question, Eric? No, I'm kidding. I'm teasing you like they tease
Lisa?
me about questions. Yeah.
Would you be so kind to like I know a lot of people are doing DPLP, we're seeing some crazy credit. I'd love to see your script or anybody that can recommend like how's the tee up?
Yep. I have a great tee up. Stephen and I went through it because it's a couple of things, guys, so that you need to know. Number one, we are not allowed to provide our client's credit report to Stephen. Okay, we are not allowed to provide our client's credit report to Stephen. And we cannot even give our consumer, according to our agreement with Credco, we cannot even give our consumer a copy of our credit report the last time I heard. We used to have a consumer version that we could print out from Credco that we could give to the consumer, but same thing, we could give it to the consumer, they have to give it to Stephen. Stephen, will you throw in the website that you recommend? There is a website that we can recommend to clients that they pull their credit to give to Stephen because it gives him it's myfico.com. It gives him all the information that he needs to help him. It's very similar to our credit report. Okay.
It's the only website to give the same exact information that you guys see on the mortgage side. No other website gives you that actual FICO classic scoring model other than this one. And it doesn't count as an inquiry. It doesn't impact the credit, but the client does have to purchase it. And the cost to do that is $30.
Right.
Lisa,
Can you give us a quick refresher on the terminology that's regulated that we are really not supposed to be using or saying?
I'm sorry, say that again.
So there's certain terminology in regards to credit repair or credit fixing.
Yeah,
We're
I'm
we're not allowed to use.
Yes,
What are
I
those?
flat out tell them that I'm not a credit repair agency, that is done by other professionals, that I have someone that I can refer them to, that Stephen offers a free consultation. They are under no obligation to pursue or use this, but I recommend they take advantage of the free consultation so that they can hear from an expert the things that will help them improve that credit score. Is that what you're looking for, Eric?
Yeah, it's just, I know, sort of, that's the conversation that I have, but it's more there's certain terminology, like we're not allowed to say things like credit repair or fixing or something like that.
I say improve your credit score. That's what I say, improve your credit score. We can say that we are not a credit repair company because we are not a credit repair company. Okay, and that's one thing. So to improve your credit score, this is what you can do. So yeah, I'll drag up. I had a really nice intro letter that I used to Stephen that basically says all of that, and I will drag that up and get a copy in the follow-up so you guys you can use it or amend it however you feel. But Stephen, really, thank you so much.
Thank you so much for having me. And the one last thing I'll say is, because Lisa, you and I have done this, if anybody wants to do a home buying seminar or a realtor seminar to you guys are building your connection, I'm always happy to do these type of Zoom events. I'll do it in person if needed. They're always free. It's just me helping you build your business and getting out this information about how credit actually works so that everybody understands. So I'm always happy to do that if anybody ever needs me.
Well, I'm going to tag you on that because I tagged Tammy's MSA last night, and I think we are going to do one for all of the Keller Williams in Connecticut.
Perfect.
So,
I'm happy to help.
So that'll be good. All right, guys, listen, have a great day. We have another guest tomorrow who's going to come on and tell us about a product that most of us don't have a lot of experience with. So I thought that was good. We can ask some some sales question. And this, obviously, you know, this is being recorded. So as soon as I get the recording, I'll send that out. All right, you guys, Stephen, thanks again. You guys
Thank you
have a
so
great
much,
day.
everyone.
Bye.
Have a great day.